Morning. Well, after having a week off, taking a little rest and rejuvenating, the news cycle was just so polite and slammed us with unbelievable amount of news this week.
Man,
Just absolutely unbelievable.
we get to talk about stuff. This is exciting.
Yeah, it's just a ton. Good morning, everybody. Brendan Rendo with the Homes in Orlando team, joined as always by Joseph Dion of Apley Home Loans. And let's look at it. We got the GDP number comes out this morning, right?
Yep.
Blows the market away.
My gosh.
Just absolutely blew them away. We got the Fed, everyone's 6 cuts. Everyone's now projecting not till June. You've got home builders missing their earnings and taking write-offs. It's just so much news out there right now that it's going to be a fun one today. Be a fun one.
And so we just got the report for new home sales. Just hit.
Yeah. Let's start with our gross domestic products. Projections were 2%. 2%. We came in at a very, very hot 3.3%.
And that's for the fourth quarter, right?
Yep.
And we've got holidays. We've got all this question mark of what was spending going to be like, what was going to happen here, and we spent. That's not like a little bit above. That's like you're blowing it out. The joy of the Fed in December, I think, is just over the past couple of weeks has been really just kind of knocked down. And I think looking at this, I easily see them not doing anything till June, if they do something in June. At this point, it almost makes you kind of worried. Are they going to look at it and go, ooh, we're too hot? Or should we do another quarter-point increase? It's tough to say, but you know what? We saw the domestic numbers for manufacturing stuff. Those came in and they were flat for this quarter, right? Durable good orders was flat. Manufacturing numbers was flat. I don't know.
One of the big ones, Dow Chemicals, who reported the same day as DR Horton, they missed their earnings huge, big time as well. And that's off the background of all the decline in manufacturing that's going on in China. China was their biggest customer. And with China not buying anything, Dow's earnings really, they missed their mark big time. In a lot of the numbers, you see the writing on the wall. And then it comes back to the old, how much is this going to get revised down?
Yeah, will it get, how much will it?
Yep.
I expect this one to get revised down. This is one of them that I expect to get revised down for sure.
Yep. And what's interesting, you look this morning, you would think that number, the T-bill, would be heading in the other direction.
You would think.
You would think
with that.
So far this morning for you, it could be a good morning.
It could be good. Now, I think by end of day, I feel like we're going to have a full reversal, end up neutral by the end of the day. But right now, it's kind of interesting. And it's almost like the T-bill and stuff has reacted a little bit more to some of these smaller reports, right? Not the GDP numbers. So they're responding to the manufacturing numbers coming in flat instead of a gain, which means that maybe we aren't continuing the same trend we saw in the fourth quarter. Jobless claims, initial jobless claims, 214K or up 25,000 week over week. That's a sizable increase. Like you said, the writing's kind of there. They're we know it's not as strong as it is, but the problem is what did we talk about last month? And every time that we talk, when rates go down, the market just heats up so aggressively. New home sales in December up 8%. We had 2 good months of rates and we saw new home sales jump 8%. And now what happens in January? Oh, we're probably going to hold off on a federal Fed rate cut. We're not going to do it first quarter. We see this news. Why? Well, because the Feds are going, look what happened. We got a little.
What just happened?
We've got that that cocaine high. They got it and they tasted it and they responded so aggressively. The markets responded so aggressively, so quickly.
Yep. Yeah, because we saw, and this came out from Reuters on the 23rd, and it everyone kind of oh my gosh, what do you mean they're not going? They're going to wait till June, And it's like, we kind of told you that.
Yeah.
You know, all these people who just read the headlines and like, oh, you know, the experts say 6. I'm going to become an expert because I love getting shit wrong and not getting blamed for it. The next time I do something wrong and my wife yells at me, I'm just going to say, but I'm an expert.
But I'm an expert. 50-50 shot. 50%.
Yeah, try that one, Joe. Yeah. Hey, honey, but I'm an expert. You know?
I've got a 50% shot of getting knocked upside the head.
So we've seen, you know, we had dropped to what, about 3.8 on the T? And we've slowly and gradually over the past week and a half or so, you've seen that push back above that 4% mark.
Yeah, we're at 4.13 right now.
Yeah. Yeah. So the jubilation, like you said, the jubilation's gone. The high is gone. And now it's kind of like, okay, yeah, we're back here again. Oh, you know, what can I do to juice the market? And it's interesting because here's our March target rate, and you still, you know, we've come way back. Back December 22nd, we're at 75% of the people believe March was going to be the first rate cut. Everyone was pushing March. Yeah. They're going to cut rates in March. Well, look at it right now. We've pulled way back. Mm-hmm. We've actually got over 50% of the people now saying, this is before the gross domestic product came out this morning. We're seeing people at 52% that, hey, we're probably not going to get it. Yep. And I expect this over the next 2-3 days, even week, probably when we look at this next week, I really expect this thing to drop to maybe about 20%. There's always those people I think are going to hold out and really believe that, hey, they're going to cut. But not with the numbers that are being put out right now. Yeah. I can't see Powell. They're going to lean on the air of caution, right? Yeah. Well, he's always said they may stay higher longer. Yep. And that plays in my head every time I'm looking at numbers. They may stay higher. You know, we've got some home buyers out there right now who are going off what people are putting out there, which is, oh, the Fed's going to cut 6 times. You know, I'm going to wait. I'm going to wait. I'm going to wait. Is there a benefit to waiting? Because I think there's ways to structure deals that can get you into something now without having to wait. Yeah. And when we get into the numbers this week, when you look at these numbers, it's time. It's time for your buyer to get out there and get aggressive with these numbers overall. And here's another interesting thing that the Fed did this morning, came out. And I'm wondering maybe this is something. But remember when the banks failed last year, they set up a new program, short-term program, just overnight, and it was called the Bank Term Funding Program, BTFP. And it was designed to help the banks with the liquidity so they wouldn't shut down. Well, what happened in November is it actually got to a point where it became an arbitrage. So they could borrow at 4.8 and stick it in the overnight with the Fed at 5.4. Now, people may say, well, that's not a big spread. Well, when you're parking $1 billion, it's a big spread. It's a huge spread. And I can't believe it took this long for the Fed to figure this out. Because you see, when that happened in November, look at the borrowing. It went from about 120 billion to 160 billion. Yeah.
I mean, but you know, this is why the banks are the banks. Like, they're smarter than us, right? Like, they figured out how they can borrow money from the government, then park it with the government and make more. Yeah. They're being paid by the government to borrow money.
Hey, Joe, how much you got in your pocket?
I don't fault them. Like, the system was designed. It allowed it. But they shut it down. What's that going to do now?
Yeah. Yep. They shut it down. It shuts down March 1st. Yep. But they still have the loans that are out there still stay in place for a year. They're 1-year term loans, 1-year term loans. So it's just interesting. If you're going to shut it down, boom, cut them off now.
Yeah, cut them off.
Cut them off.
We'll see it surge a little bit more.
Just incredible news day from the Fed. You know, the GDP numbers, all these other numbers, and then we've got our good old friends at the hedge funds out there, Joe.
Well, I trust
the ones that
I trust the banks.
Yeah, BlackStone, right?
BlackStone, they buy everything.
They buy everything. They do. But you know what? they don't feel like paying,
Well, that's commercial real estate.
Yeah, it's not like it's going to hurt anything.
No,
right?
like they see the writing
no.
on the wall.
No. So here's BlackStone, who walked away from their headquarter building in New York City.
Walked away. So
Okay.
literally just walked away. Defaulted.
Just walked
Said,
away. Yeah.
Forget it. We're not
Yeah.
paying our bills.
Yeah. Just
They
defaulted
must
on
be. So they must be struggling.
Yeah. $308 million default. Hey, I'm sorry. Things are so tight right now. I couldn't buy my kids any Christmas presents, anything like that. Hold on. Wait, I'm sorry. I actually have $200 billion of dry powder that I'm going to spend.
We're going to default on our loans because not good investment, but we still have 200. The common person can't do this shit. Like,
no.
How do they get away with that? How do they sit there and say, hey, we're just going to default. We're not going to pay this. It's commercial. It's bad investment. We're going to let it go.
Yep.
And then but have all the financial means, and that's the crazy part. Like, they have the financial means to they could have paid the loan. They could have paid it in full.
Yep.
They chose not to because it was a bad investment.
Yep. But right now they have $200 billion to invest.
Pennies.
$200 billion. And they just promoted like 6 guys. And let's see, for more than 60 years, collective experience investing for BlackStone, and would lead an extremely active period of investment with over $200 billion to spend.
I like it.
Yeah. Yeah. So it's going to make it real fun again.
With buying season.
When you start going out and all of a sudden you see this cash offer pop up, it won't be under BlackStone's name per se. No, can't do that. But such and such investment company I'm going to come in and I'm going to offer you 10 grand above what your asking price is. And then they're going to rent it. I know there is legislation out there
to potentially prevent institutional buyers, right?
Yes.
That legislation getting passed, I can't see it making its way.
Not when they got everybody in their back pocket. So you've got this going on in the background too. And then DR Horton this week came out with their earnings, missed, just flat out butthurt miss on their earnings overall.
Yeah.
And when they were going through it and disclosing it, they were down 9.2%. And what's the reason for being down close to 10%? And basically they've dropped 220 basis points per house. So they're losing some serious money per house, and they had to take a $65 million charge to cost of goods sold. What is that charge? It's those incentives that we see for every home builder that's out there right now, buying down those rates.
Yeah, which is great. Like for the consumer, it's great. It's advantageous. Take advantage of it, right? DR Horton is an example, and a lot of home builders, they got caught that when you do that, the moment rates start going down, they're stuck. They're taking losses.
They will. They're doing everything they can to keep the prices here.
Yep.
And people are wondering why haven't home prices fallen yet? Why haven't home prices fallen yet? Well, a couple reasons. One, most of the people who own homes aren't reselling them. So those numbers are way down. So what are the sales numbers based off of? Sales numbers are majority based off of new home sales. Well, the builders aren't going to discount the price if they don't have to. But you know what? We're going to give you so many incentives that you've got to buy the house. Here it is. On top of DR Horton said it had increased the use of buy downs during the quarter. That 70% of its deals were made with mortgage rate buy downs, up from 60% the prior quarter.
80%.
And that 80% of the mortgages originated by its mortgage company were done with buy downs.
Yeah.
And the cost of those buy downs, Joe. They're not cheap.
Mm-hmm.
They are not cheap at all.
And this was DR Horton incentive. Like, so they're paying for it. The builders were paying these buy downs, right? These incentives to get that, to keep consumers in so that they can keep prices where they wanted.
Yep.
Right now, once rates stabilize, Q1 or Q2 of this year, they may be record profit.
But you look at where the prices of the homes are still, and what did we say this year is going to be all about? It's going to be all about affordability.
Yep.
So if I still got a DR Horton home, say for instance in Sorrento, they've got a development out there, and I think they've got 15 quick move-ins ready to go. They got to move these things to keep the cash flow going.
Yep.
And they're offering 2 points and sometimes 3 point buy downs on these homes. And it's the only way, because if you keep it at that 6.5%, where are we, 7% right now?
Yeah, right around 7%.
People can't afford those homes.
Yeah, because these are new builds, which means they don't have set tax bills yet. So they're using basically tax estimates, which for affordability, for qualifying, we know the tax estimates are higher than what the tax bill end up being. But the thing is, they have to qualify on that estimate from the county. Right? Yep. That's based off the sale price, not off of the assessed value that the county is going to give it, because the county hasn't given it an assessed value yet.
And I thought this was interesting, and I had to ask you what this meant. To hedge those buy downs, the company buys, quote, forward commitment pools for the next few weeks of deliveries, essentially.
Yeah.
Explain that.
So kind of what a forward delivery is, basically when and it's a strategic place. If you do it right, you can make a lot of money. If you do it wrong, you can be screwed up, right? So when they do a forward commitment, basically what they're saying is, hey, we're going to deliver this many loans at this interest rate over the next 30, 60, 90 days, whatever it is, right? Now, when they go in and do that, they're paying a premium to do that, right? Because they're basically locking in today's pricing, right?
Yep.
But they're paying a premium to allow today's market pricing to carry for 30, 60, 90 days, whatever the time limit is, right?
Yep.
So they're prepaying this. So whether they deliver those or not, they've already paid for it. They've already spent it, right? And then if rates go down and they committed at this higher market, right? There's no savings for them. They already committed at the higher price. So now they're losing out.
And that's why I'm getting inundated every single day. It's not like a couple times a week now. It's every single day from every builder with their quick move-in sales.
Yeah.
Because it's not just DR Horton who's playing this game.
Yeah.
It's all of them. It literally is all of them are playing this game. So it's interesting to see, because we I'm not sure when Lennar reports. I need to look that up. And some of these other Pulte and some of these other big builders, when are they going to report on this? Because I think we're going to see their stocks and their numbers struggle for a little bit this year until we start getting, start seeing some of those rate cuts down the road. There's a lot of interesting stuff that's going on right now, and it's affecting the overall market. And that's why I think it's still a good time for a lot of people to look at houses, because you're seeing the pullback, you're feeling the pullback. And when we look at numbers this week overall, we're seeing
big void of nothingness.
Yeah, I know. Don't make fun of me. I tried something new today, and it actually worked okay. So I wasn't too disappointed.
I think it was great.
Here's our numbers for the week, and it just goes to show you that things are tight. I mean, we're down to 244 sales. That's low. That is low. But then you see people, they'll say, "Oh, but price," they play the game of, "Oh, but look, prices were up 7.1%." But we know, looking at it every week, it fluctuates, but it's actually stayed pretty steady.
Yep.
You're going to have that one high sale, that one low sale. For instance, with our condo market, we're down to 83. We have been consistently below 100 sales in the condo market for over a month now. And it's interesting because I actually put in an offer yesterday on a condo, and the latest comp in September was $179,000. Ours pretty similar, a little more updated. So we went 182.5 cash, and the agents, well, they're looking at the sale from 8 months ago that for 210,000, and it's like, like that sale's not worth anything, because you've got a new sale. And have you explained to them the actual numbers of what's going on with the condos right now?
Yeah.
It's just like, well, okay. Well,
I want to be selective. I want to be like, hey, ignore that little one. That guy doesn't matter.
Yeah, that guy doesn't count.
I know it's a more recent sale in my neighborhood. No, it doesn't matter.
And I'm like, okay, so if an appraiser comes in, what's he going to pull? He's going to pull they usually do 6 months. So I've got one that matches up. Condos are easy because you basically go square footage, match up your square footage.
Yeah.
Right?
You're going to have the same floor plans.
Same floor plans. So here's my best comp. And then the ones that are actually bigger, they both went for one went for 205 and one went for 206. Okay. So, we're going to adjust for our square footage, basically. And guess where we come back down to? Where we started. I'm like, I can throw an appraisal contingency in there, but what do I need to? Because I can tell you exactly what the value of the place is. It's not, not rocket science in this situation. And then we got our inventory. We're still growing in on our inventory.
Yep.
Overall, we're up to 37. Then this was the thing that really, really kind of just blew me out of the water. Original list to sales price.
Down 8%.
Before the end of the year, we had dropped about 94.5.
Mm-hmm.
We're at 91.99%. And it's across the board.
Yeah.
Under 250K, 88. 250 to 300, 93.7. 300 to 400, 94.5. 400 to 500, 94.7. 500 to a million, 93.6. Over a million, 84. Everyone's dropping their prices.
Yeah, across the board. There's deals there's opportunity to negotiate every which way.
Every which way.
For that buyer.
Yep. Inventory's up. Price drops are increasing. Days on market. We've jumped to 61 days on market for average. Mm-hmm. So it's pushing. It's really pushing. You got home builders giving all kinds of incentives to buy a house right now.
Yep.
It's absolutely amazing. And then you just see, since September, that we were up averaging 350, jumped to over 400, but you've got a steady decline in home sales.
Yep.
People are tapped.
Yeah. It's winter. It slows down usually to winter, but everything else is kind of playing into it. I think, credit card consumer debt, highest it's ever been. Like we're not as strong as some of these reports make it look. And this data, the data is pointing to the picture that we can see.
Yep.
Right.
We took a little dip in our inventory, which we knew we were going to do, like we always do towards the end of the year. And then, of course, we're slowly starting to pick up. And you can see since beginning of December, we were about 50, 46. We've jumped over 10 days.
Yeah.
On market average. Same thing in the condo market. Condo original list to sales price, we're at 93%. Days on market, we've jumped to 67.
Yeah.
So overall, as a buyer, I'm looking at ways and looking for programs that are going to help me get into a house now. And I know you brought one up to me that we're going to do a special presentation on either later today or more likely tomorrow that can really provide a nice opportunity for buyers. Why don't you hit a couple highlights on that?
Yeah. So it's the program is actually really, really cool. It's for first-time home buyers. And we'll actually, let me rephrase that. If there's multiple borrowers, only one has to be a first-time home buyer. You can't own. It's a 3% conventional. But what's really cool is if you live in certain designated census tracts, where there were only 5 or 6 when the program came out in 2022, is when it kind of came out, really rolled out in 2023. Central Florida wasn't any of them. Now, within the last couple months, Tampa, metropolitan area, Orlando metropolitan area are now part of the census tracts areas, to where if you live in a specific location, you might qualify for a $5,000 grant to be applied for down payment closing costs, plus get reduced mortgage insurance, improved Fannie Mae program. It's a Fannie Mae I'm excited about this. I think there's a lot of opportunity. $500 appraisal credit, $500 toward a home warranty. So almost $6,000 in incentive that's coming from Fannie Mae for borrowers that live in a specific. But the kicker is they just have to currently live in the census tract. They don't have to buy in that census tract.
This is going to be interesting. This is going to be really.
I think as it launches and it goes out, we're going to see it stimulate some. It has a potential to stimulate some purchase business.
Definitely, and that's one of those. Quite honestly, as a realtor, I'm willing to help that buyer as well through my commission, through a closing cost contribution of my commission.
Yeah,
because the whole point is to help these people get into houses, and that's our goal. That's always been our goal. Get as many people into houses and into home ownership as we possibly can. So I'm looking forward to getting more details on that and putting together a great presentation. So we can let people know, get people ready to take advantage of this, because you never know with Fannie Mae how long they may last. The
program is there today. Will it be there tomorrow? We don't know.
We don't know. Well, thank you for your time today, Joe. Great show. A lot of news. Thank you, everyone, for joining us, and we'll see you again next week. Take care.
Have a great one, guys.